Hi, my name is Larry Donahue with Law for Small Business. I'm one of the lawyers, and today we're going to talk about acquiring a business. We're going to give you a little checklist. Going to talk about a high-level series of steps, and then we're going to go into a little bit of detail with all of these. But this is all high-level because every business, every transaction is different. So there are 5 general high-level steps with acquiring a business. Step number 1 is finding the business and the right business for you. Step 2 would be negotiating terms for the business. How much? When is the closing? What assets and liabilities come with the purchase or don't come with the purchase? Step 3 would be due diligence, evaluating the business, making sure it's really worth what you think it's worth, and that you're getting what you think you're getting, and you're not getting things that you don't want. 4 would be the closing, and that's when you actually take possession of the keys in the business. And then finally, 5 would be post-closing activities. So let's talk about those 5 things for a moment. So the first step would be finding the right business. And I'm not going to spend a lot of time at this because most people already have a business they're looking at or thinking about. But what I do want to tell you is, if you already have the right business, you still owe it to yourself to shop around. You want to see, the business that you're thinking about. Is it really as great as you think it is? And determining value is not just how much money it's making, but it's also a function of what other businesses are doing. For instance, if you're considering a really cool buggy whip company, I would argue that business is dead or declining and very specialized. It's not worth what it was in the 1800s, for example. And, you can imagine like MySpace. MySpace was worth a lot of money even just, 15 years ago, 10 years ago, and it's not worth so much today. So you want to kind of see where the industry is trending and so on in order to think about the right business for you. The other thing is what stage of life are you in and how experienced are you at this thing that you're considering? So if you are retiring, you want to move from one of the big cities, New York, Chicago, and you want to LA, and you want to move to, a slower lifestyle. Are you buying a lifestyle company? Does that really make sense? Do you understand the culture that you're moving into? Does it fit with who you are? And then, finally, do you have the experience? And when you look at financials, is it, one guy or gal or a small group of people that, they're doing business with their friends, and then when they leave the business, the friends are going to leave? Or is it something a little more in your control? And, how specialized do you need to be? Is there licensing requirements? For instance, if you don't have a law degree and you're a member of a bar, you're not going to be able to buy into a law practice. And I know that's a silly example, but that same thing applies to, physical therapy, chiropractic services, medical, dental, even certain types of home care businesses, for example. Some are licensed and some are not, depending on the level of touch and other aspects of the business. So you really want to look at kind of the licensure issues and other specialty issues and ask yourself, is that really something that you are experienced in? And if you're not, I want to warn you, there's a statistic. 93% of businesses fail within the first 3 years. Think about that. 93% within the first 3 years. So, are you going to be one of the 7% and succeed? And I would argue, if you know the business and you've done it before, that you're probably, you may be in the 7%. But if you haven't, you're probably going to be in the 93%. And I don't mean to be so negative, but you need to really go into this with eyes wide open. So that's about finding the right business, and I'm going to stop belaboring the point there. Let's talk about some of the other factors or the next steps. So let's say you do find the right business and this is what you want to do and you're ready to go at it. The next step would be negotiating terms. What does that mean? Well, the purchase price is a big one, but do you have enough cash to lump down all at once? Most people don't. So what they will do is either, obtain, pay some in cash and then finance the rest. And financing, there's a lot of options. But let me break it down into two big categories. One would be like third-party financing, like the SBA, banks, friends and family, versus seller financing, where the seller of the business is going to put some sort of promissory note together and allow you to pay in installments over time. So third-party financing versus seller financing. That goes in the terms, and you negotiate that. And maybe the seller wants to buy their tropical island and they can't afford it until they get the full purchase price, and so maybe they're willing to have you pay over 6 months. That's a very difficult note to pay off versus paying it off over 20 years or paying it off relating to profits. The other thing I want to warn you about when you're talking about negotiating terms and pricing is, are you really getting what you think you're going to get? And let me explain this. I'll pick on an insurance agency. When you buy an insurance agency, the value is relating to the number of policies you have, number one, and then two, how many of those policies are going to exist over time. It's called churn. How many of them are going to bleed off, or how many can you rely on for further reoccurring revenue of the business? Well, you might not want to pay the full sale price on day one. You might want to say, look, I'll pay you half now, and then I'm going to pay you the other half in 12 months or 18 months or 24 months after we've seen how many of these customers are going to stick around. And then you put some sort of formula together. It says, look, if I lose 10% of the business, 10% of the sale price, you would forego 10% of the sale price. I'm just making up numbers here, but you get the concept. There's other aspects regarding negotiations. What assets exist? Are all the assets coming over, or only some of the assets? Are there liabilities? Are you taking on the liabilities or not? Are there other special circumstances that you care about? Maybe you want the seller, the owner, to stick around for 3 months or 6 months or more to train you and help you keep and move and migrate the customers over. I see that, for instance, with accounting practices, where a new accountant will either move in from another state, or a younger guy or gal will buy the practice of an older retiring accountant or CPA, and they'll want that CPA, the seller, to stick around for a year or so to help the customers and clients feel comfortable with the new accountant or CPA, for example. That would be some stuff to negotiate. There's intellectual property issues if you're buying a software company or a web development company. Maybe partnership issues, employment issues, or employee issues. All of those business issues should be negotiated. When you're done with the negotiation, then you as the buyer want to produce an LOI, or letter of intent. That letter of intent is going to specify all the specific high-level business issues, and you should consider having a business lawyer help you generate that letter of intent. It's non-binding, but it does specify what the deal is going to look like. Also, when the closing date might happen, what kind of due diligence, how that might work out, and then how you might pull out of the deal if the due diligence doesn't work out. So now let's talk about due diligence. You've successfully, if you found the business that you want to buy, you've successfully negotiated the terms, and both you as the buyer as well as the seller agree on how that's going to happen. So now you've generated an LOI, letter of intent, and everybody signed it. Now we have due diligence. What does due diligence look like? So due diligence is where you need to evaluate the business. Is it generating the revenue that you were told and you think it's generating? Are the assets where you think they are and have the value you think they are, right? If they say, that we own 3 trucks, okay, are they brand new, Ram trucks that, have, they're worth $70,000 a piece, or are they super old and ancient, Ford Ranger trucks, without a lot of horsepower and going to fail in the next month or two. You need to look at the condition of the assets. So due diligence involves a lot of things, and you cannot take the easy road on this. You need to dive in, and I would recommend you hire people to help you. The three people that you should consider helping you with due diligence, one would be an accountant, bookkeeper, CPA, to dive in and look at the financials and the tax filings to tell you what the real sort of state of affairs are from a finance perspective. You should have a lawyer help you. Look at contracts, look at assignment clauses, even if it's just a lease. Most businesses have more contracts than the lease. And we'll talk a little bit more about that in a minute. And then finally, consider talking to a banker. If they have notes or lines of credit, other financial products, a banker might be able to help you evaluate some of that stuff. Do they earn a lot of money and revenue on merchant accounts? So what's their chargeback rates and ratios? And are there ways to save money there? Are you going to accumulate a lot of liability? So those three people can help you: a CPA or accountant or bookkeeper, a lawyer, and a banker. So what else do you want to do with due diligence? You want to look at all the ownership and formation documents. You need to look at those, especially if you're going to buy the business versus buying the assets. You want at least 3 years of financials and tax filings for the business. And if it's a disregarded entity or a partnership or sole proprietorship, I'm sorry, you're going to need to look at their personal tax filings to see exactly what they're reporting for income and other issues regarding the business. You want to conduct a lien and title search on the assets and the business and the owners. You want to look at the bank accounts themselves and the merchant statements. You want to see what kind of chargebacks are going on. You want to see what kind of money is going in and out. You want to sort of validate the revenue and the income. You want to evaluate and validate all assets and liabilities. Lists, like customer lists, gift certificates if they have those, important contracts, including leases and utilities and insurance and payroll services, vendor contracts. If contracts for the customer are important, let's say you're considering buying an alarm company, you care about the contract of their customers and how the terms and termination clauses, you need to look at those and evaluate those. You don't want to leave any stone unturned. The goal here is to figure out what the value of the business and its assets and liabilities really are, and that you are aware of everything that you're acquiring when you buy a business. During the due diligence period, by the way, is when the purchase agreement is being constructed by your lawyer, and the acquirer or purchaser is the one that usually generates the purchase agreement. And it will have a lot of specifics, and you cannot take the easy road here. There's going to be representations and warranties, there's going to be indemnities, limited liabilities. If there's seller financing where you're going to pay them over time, there'll be a promissory note. There may be a security interest agreement where some of the assets you're buying are going to be encumbered by a lien to help protect the buyer until you pay them. A lot of complexity there. And then it needs to be negotiated with the seller's attorney, and that can take time. So you want to do that during the due diligence phase and hopefully get it signed prior to closing, so that once due diligence goes through, you can either pull out of the deal because the due diligence uncovered something that makes you want to cancel the deal, or you go through with the closing. Let me talk about closing and then post-closing. So closing is the proverbial you own the business. And it's going to happen on a very specific time. And you owe it to yourself to be a little strategic about that date. If you're taking on new employees, it would be best not to have a closing in the middle of a pay period for the employees. Ideally, you don't want it in the middle of a month. Somehow that might make taxes or income taxes or gross receipts taxes difficult to calculate. Depending on how the company or business earns revenue, you want to figure out whether outstanding invoices, the money that's paid on those, go to you or go to the seller. So you got to be strategic about that closing date. and you want to put a closing checklist together. You want to figure out, how all the pieces come together, as it relates to contracts and employees and accounts receivable and accounts payable, for example, too. The electric bill, who's paying that? That it comes in tomorrow, and it related to the business for the previous month. You got to think through all those issues and have them all spelled out. The closing is where the purchase agreement, bill of sale kick in. Related documents, maybe an employee agreement or corporate resolutions or escrow accounts, all of that ties in together. On the closing date, if the business is leasing space, you should have a new agreement with the landlord. The landlord has assigned the lease over to you, and you take over at that time. And everything, basically, you get the proverbial keys to the kingdom. And now you are responsible going forward, and anything that comes to the business that related to an activity prior to the closing date would be the responsibility of the seller, hopefully, if that's what you've negotiated. So the closing date is a very specific point in time, done strategically, factoring in all the different aspects and financial aspects of the business. Finally, some post-closing activities for you to consider. And what I'm about to tell you, you need to double check with your attorney and your CPA to get the right list, because it's going to depend on what kind of purchase you've done, and it's going to depend on the kind of business. But in general, post-closing activities are going to include the following: IRS Form 8594 relating to the assets, IRS Form 8822-B changing the identity of the responsible party if you've purchased the shares or the membership interest, if it's an LLC, of the business, versus an asset purchase. If you've done an asset purchase, you will not send in Form IRS 8822-B. Those would be the high-level post-closing activities to think about, as well as employment agreements, retirement accounts, payroll accounts, and so on. So that's a quick high-level overview. I know this has been a little bit of a long lecture, but I appreciate your time so far. I wish you the best of luck, and if you're interested in having a lawyer or having us talk to you or weigh in, please call us at your convenience. You can reach me at 505-715-5700. I am licensed in New Mexico and Illinois. Our firm has lawyers in other jurisdictions, including Texas, Arizona, Florida, and we're looking for other lawyers in other jurisdictions as well. And if we don't have a lawyer in your jurisdiction, we'll give you some advice or maybe refer you to somebody. You can also go to our website at www.l4sb.com. Thanks for your time, and good luck to you. Goodbye.